Welcome to the deep dive. Today we're tackling something really core to business accounting entries. Forget the dense textbooks, okay? Our mission here is to give you a real shortcut, a way to genuinely understand the financial heartbeat of any company. We've got a great practical guide to walk us through it. And honestly, by the end of this, you'll feel much more confident about this, well, sometimes intimidating topic. Okay, let's unpack this.
Absolutely. And it's fascinating, isn't it, how these seemingly small records, these entries,
Yeah.
they actually build the entire financial picture. Accounting entries, they're the formal, precise records. Every single financial transaction.
Every single one.
Yes, they are the absolute bedrock of transparent financial reporting. And frankly, without them, good decision making. It's just, well, it's nearly impossible.
So it's like the company's financial DNA, you could say.
That's a perfect way to put it. Exactly.
Okay, so every financial event gets logged. But how does that system actually work? I mean, I've heard people talk about the double entry system. It sounds kind of serious. What is it? Why is it so important?
That's a great question. And the double entry system, it's really quite clever when you think about it. It just means that every single transaction affects at least two accounts, always two, minimum.
Two accounts, okay.
And for every debit entry you make, there has to be a corresponding credit entry for the same amount.
Ah, okay.
It's not just some random rule. It's got this built-in checks and balances system. It makes sure that core accounting equation assets equal liabilities plus equity stays perfectly balanced. Always.
After every single transaction.
After every single transaction, it's like having this constant internal audit, making sure everything adds up.
Wow, okay, so it's like a self-correcting ledger, almost. Every action has an equal reaction somewhere else in the books.
Precisely. That's a good way to think about it.
That's a really powerful check. Okay, so we know how things are balanced. But you mentioned entries. Are they all the same? Or is it more like a process?
It's definitely a process. You don't just make one kind of entry. Usually a transaction goes through about 4 key stages, or, well, types of entries.
4 types.
Okay.
First up, you have journal entries. Think of these as the first draft, the raw diary.
The diary.
Yeah, a chronological log of every transaction as it happens, just noting what went down and when. Very straightforward.
Okay, raw data dump, basically.
Exactly. Then, from those journal entries, the information gets organized. It's moved into ledger entry.
Ledger.
So if the journal's the diary, the ledger is where you start sorting things. All the cash stuff goes into the cash account ledger. All the sales into the sales ledger. You get the idea.
Ah, so it's like creating specific files for each category.
Precisely. This is where the raw data gets classified. It gets organized so you can actually start analyzing it later.
Makes sense. What comes next?
Then you have adjustment entries. Now, these are really important, and they usually happen at the end of an accounting period, like a month or a year.
Okay. End of period adjustments. Why?
They're for catching things, income or expenses that have technically happened but haven't, been formally recorded in the daily flow yet.
Like what? Well, our source material has a great example. Salary outstanding. Say your employees worked the last week of the month, they've earned that salary.
But payday isn't until next month.
Exactly. The company owes the money, the expense has occurred in this period, even if the cash hasn't gone out. You need an adjustment entry to show that liability.
Got it. So it reflects the reality of what's owed or earned, not just when cash moves.
Perfectly put. And finally, the 4th type, closing entries.
Closing entries. Sounds final.
They are, for the period anyway. They're done right at the end of the accounting cycle. Their job is to transfer the balances from your temporary accounts.
Temporary. Like revenue and expenses.
Exactly. Those accounts track performance over a period. Closing entries move their final balances into permanent accounts like your capital account or retained earnings.
Okay, why do that?
It basically resets those temporary accounts back to zero. It clears the decks so they're ready to start fresh for the next accounting period, like wiping the scoreboard clean before the next game.
Ah, okay. So journal, ledger, adjustment, closing. That's the flow.
That's the typical flow, yes.
Now, to actually make any of these entries, you need the rules, the debit and credit stuff. This seems like the part where people get a bit lost.
It can seem tricky at first, but honestly, there's a solid logic to it. Once you grasp these basic rules, it really does start to click. They're like the universal grammar for accounting.
Universal grammar. I like that. So what are these rules?
Okay, let's break it down by account type, just like our source does. It's all about how debits and credits affect each type.
Right.
First, assets. Think cash, buildings, equipment stuff the company owns. For an asset account, a debit makes it go up, it increases it. A credit makes it go down, decreases it.
So more cash means debit cash.
Exactly. You receive cash, you debit the cash account, you spend cash, you credit the cash account.
Okay. Assets. Debit up, credit down. Got it. What about liabilities? Money owed?
Liabilities, loans, accounts payable, that sort of thing. It's the opposite of assets. A debit makes a liability go down, decreases it. And a credit makes it go up, increases it.
Opposite. So if you take out a loan, liability goes up. That's
Yeah.
credit.
That's right. You credit the loan payable account. When you pay back part of the loan, you debit it, reducing the liability.
Okay. Liability. Debit down. Credit up. Next.
Expenses. Things like rent, salaries, utilities, these behave like assets in terms of the rules. A debit increases the expense. A credit decreases it, though. Decreasing an expense is less common day to day.
So paying rent, an expense, means you debit the rent expense account.
Precisely. Debit rent expense.
Expense, debit up, credit down. Okay. How about income?
Income or revenue like sales. This behaves like liabilities. A debit decreases income. A credit increases income.
So making a sale, earning revenue,
Hmm.
income goes up. That's a credit to the sales account.
You've got it. Credit sales.
Income, debit down, credit up. Last one.
Capital or owner's equity. This represents the owner's stake in the business. It follows the same pattern as liabilities and income. A debit decreases capital. A credit increases capital.
So if the owner puts more money into the business, capital increases. That's a credit to the capital account.
Yes, exactly. Credit capital. And, stepping back, these rules, this whole debit credit framework,
Yeah.
it's what ensures that consistency we talked about. It's why financial information is comparable across companies, across industries, even across countries. It's the standard language.
Universal language of business finance, allowing everyone to read the same sheet music, basically.
That's a great analogy. Yes.
Okay, that framework makes sense.
Yeah.
Debit credit isn't arbitrary. It depends on the type of account. Now let's make this really concrete. Let's use the examples from our source. They use rupees, but
Yeah.
like you said, the principle is the same everywhere.
Sounds good. Let's put the rules into action.
Okay, first scenario. Sold goods for $10,000 in cash. Walk us through the entry.
Right. So, two things happening here. You got cash and you made a sale. Cash is an asset. Is your cash going up or down?
It's going up. We received it.
Correct. And the rule for increasing an asset?
Debit increases assets, so debit cash.
Perfect. Debit cash account 10,000. Now, the other side, sales. What type of account is sales?
That's income.
And is your income increasing or decreasing?
Increasing. We made money.
Right. And the rule for increasing income?
Credit increases income, so
Yep.
credit sales account.
Exactly. Credit sales account 10,000, so the full entry. Cash account debit euro 10,000 to sales account credit 10,000. And often you'd add a little note, a narration like being goods sold for cash.
See? Debit equals credit. Okay, I think I'm getting this. Let's try another. Purchase goods worth 5,000 euros on credit from Here's ABC Traders.
Okay. What are the two main things here?
We got goods, so purchases. And we owe money to ABC Traders.
Good. Purchases, we usually treat that as an expense for this purpose. Is the expense increasing?
Yes, we acquired goods.
The rule for increasing an expense.
Debit increases expense.
Yeah.
So debit purchases account, 5,000.
Spot on. Now, ABC Traders, we owe them money. What kind of account is that?
That's a liability. We owe them.
Is the liability increasing or decreasing?
Increasing. We owe more now.
And the rule for increasing a liability?
Credit increases liability. So credit ABC Traders account 5,000.
You nailed it. Purchases account, debit 5,000. To ABC Traders account, credit 5,000.
Okay.
That-
How about a simple operational cost? Paid office rent of 8,000 via bank transfer.
All right. Accounts involved?
Rent, which is an expense.
Yeah.
And bank, which is an asset.
Good. Rent expense. Increasing and decreasing.
Increasing. We incurred the rent cost. Rule.
Debit increases expense. So debit rent account, 8,000.
Okay. And the bank account. We paid from the bank.
So the bank asset is...
Decreasing. Money went out.
And the rule for decreasing an asset?
Credit decreases assets. So credit bank account, 8,000.
Perfect. Rent account, debit euro 1,000 to bank account credit 8,000.
It really does flow logically once you have those rules down. What is its income, but not our main sales? Example, receive 2,000 as commission in cash.
Okay. What did we receive?
Cash, that's an asset. It's increasing.
Bro.
Debit increases asset. Debit cash account, 2,000.
Good. And why did we get the cash?
Commission income, that's income. It's increasing.
Ooh.
Credit increases income. Credit commission income account, 2,000.
Excellent. Cash account debit euro 2,000. to commission income account credit year 2000?
Okay. How about when the owner puts money in, proprietor introduced 50,000 as capital in the business. Assume it's cash.
Right. So cash comes into the business, asset increasing.
Yes. Debit cash account 50,000.
And where did this value come from? The owner's contribution. That's capital. Is capital increasing or decreasing from the business perspective?
Increasing. The owner's stake grew.
And the rule for increasing capital.
Credit increases capital. So credit capital account 50,000.
Exactly right. Cash account debit euro 50,000 to capital account credit 50,000.
Okay, last one. Let's revisit that adjustment entry. Salary of 15,000 is due but not paid. This felt a bit different.
It is, but the rules still apply. Think about the expense first. Has the business incurred a salary expense?
Yes, people worked, so the expense happened.
Right. Salary expense is increasing. Rule.
Debit increases expense. Debit salary account 15,000.
Good. Now, did cash go out?
No, it says not paid.
So we can't credit cash or bank. But the business now owes this money. What does owing money create?
A liability.
Yes,
Yeah.
we create a specific liability account, often called outstanding salary or salaries payable. Is this new liability increasing or decreasing?
It's increasing. We didn't owe it before, now we do.
And the rule for increasing a liability.
Credit increases liability. So credit outstanding salary account 15,000.
Bingo! Salary account debit 15,000 to outstanding salary account credit 15,000. It perfectly captures the economic reality of that period.
That makes so much sense now. Seeing the examples really hammers home how those rules work across different situations.
It does. Practice with examples is key.
So bringing it all together, why is all this detail, the double entry, the specific entry types, the debit credit rules, why is it all so fundamentally important for a business? What's the big why care for anyone listening?
Well, the importance is huge, really. It goes way beyond just, bookkeeping. Getting these entries right is like having X-ray vision into a company's financial health.
X-ray vision. How so?
First, just fundamentally, it maintains accurate financial records. That's the absolute baseline. No accuracy, nothing else works.
Rubbish in, garbage out.
Exactly. And these accurate records, they're what allow you to prepare the vital financial statements, the balance sheet, the income statement, those snapshots of business health.
Okay, accuracy leads to reliable reports. What else?
Second, it's crucial for compliance. Think taxes, audits, regulations. You absolutely need proper, systematic records to meet those legal requirements. Imagine trying to file taxes without this.
Yeah.
Nightmare.
Yeah, definitely not something you want to mess up.
And finally, maybe most importantly for running the business day to day, it's essential for good decision-making and tracking performance. How do you know if a product line is profitable? Or if you can afford to expand? Or where costs are getting out of control?
You need the data.
You need accurate, well-organized data, which brings up a key question, right? Without these precise entries, how could any business truly know where it stands financially? How could it possibly spot risks or opportunities effectively?
It would be flying blind.
Pretty much. This system provides the visibility needed to navigate.
That really drives it home. Okay, so we've covered a lot of ground. From what seemed like maybe complex jargon, we've unpacked the double entry system, the journey of a transaction through journal, ledger adjustments, and closing entries, and crucially, those core debit and credit rules.
Yep.
Plus, we saw them work in real examples. You've genuinely just got a major shortcut to feeling, well, truly informed about this foundational language of business. It's not just surface knowledge now.
Absolutely. And, knowledge like this, it's most powerful when you actually understand it and can apply it.
So what's a final thought for our listeners to maybe chew on?
Well, think about how understanding these entries changes your perspective. It helps you not just know facts about a business, but to really start to understand its financial health, its story, its trajectory. So the question to ponder is, how might this deeper understanding change how you interpret financial news about a company? Or maybe even how you look at your own personal finances? How does seeing the mechanics underneath change the way you view the results?